guys, Irfan back again with another video, and this is actually a second video in the insurance series. In the first video, we talked about trying to explain what insurance was and what it means to have insurance or have an insurance policy, or if you know what somebody means when they are saying they're taking out an insurance policy. In this video, what we are going to be looking at is what type of insurance, what are the common types of insurances out there. Okay, now I had mentioned this in the previous video, and I'll just be repeating that in this video too at the very beginning. This video is for educational purposes only. Now, if you are looking to buy insurance, or if you have insurance and you want to make some changes, or if you have any questions regarding the insurance that you want to have, or you have any the changes you want to make to it, you need to be talking to somebody who is actually trained and licensed to give you advice on insurance. And if you're looking to buy insurance, then the person needs to be licensed to sell insurance. So you need to talk to a professional, like I said, who is trained and licensed to do that. This video is for educational purposes only, and that is why we have the disclaimer up on the screen right now. Now, having said that, let's move along, and let's look at the different type of insurances that we have. So I've got the list up on the screen. So there are about 11 different common types of insurances that we have listed up here. So let's go through each of them one by one, and try and explain and try and understand what each insurance actually means, right? So let's start with the auto insurance. Now this, as the bullet says, this is type of insurance. It protects the policyholder against financial loss in the event of an incident involving a vehicle which they own, such as a traffic collision. Now, coverage in this type of insurance typically includes property coverage. That would be that if your car was damaged or if the car was stolen, the auto insurance would cover that. The liability coverage for the league would be for the legal responsibility to others for the bodily injury or property damage. And medical coverage, part of this auto insurance, would be for the cost of treating injuries, rehabilitation, and sometimes lost wages, and unfortunately in some instances funeral expenses. So that's what in a nutshell is auto insurance. Now let's go to the next one, the gap insurance. Now, gap insurance actually covers the excess amount on your auto loan in instance where your insurance company does not cover the entire loan. Okay. Now, depending on the company's specific policy, and it may vary from company to company, it might or might not cover the deductibles. Okay, it might or might not cover the deductibles as well. Now, the primary target audience of this type of coverage is for those who are putting down a very low down payment, and that have high interest rates on their loans, and they have 60 or more months a longer term on their auto loan or any type of loan, mostly in the auto loan. Now, gap insurance is typically offered by a finance company when the vehicle owner purchases their vehicle, but many auto insurance companies also offer this coverage to the clients. So it basically is going to cover the excess amount of your auto loan in the instance where your insurance company does not cover it. All right. So that was a very quick explanation of what the gap insurance was. Now let's move ahead and look at the health insurance. Now, health insurance policies cover cost of medical treatments. Okay. Now, similar to that would be dental insurance. Like medical insurance would cover policies holders for dental work if you need bridges or root canals or what have you. So dental coverage would cover dental work. Health insurance would cover cost of medical treatments. Now, in most developed countries, all citizens receive some health coverage from the government, which is actually paid for by the taxes the public pays. You know, and in some countries, health coverage or health insurance is also a part of the employer's benefits. So that's if you're working for a company, the company may offer you as part of the benefits program health insurance. In the US, this has become slightly controversial with the Affordable Care Act, also known as the Obamacare, which was enacted by President Obama, Barack Obama, and which is now being targeted by the Republicans and President Trump. So, like I said, this has become slightly controversial in the U.S. But that's basically what health insurance is. It's going to cover your cost of medical treatments, right? So, moving along, income protection. Now, in income protection, basically, it's providing financial support in the event that the policy holder is unable to work because of disabling injury or illness. All right. Now, what that basically means is uh, the if a worker has income protection insurance and he or she becomes sick so that they cannot work or they become injured and they cannot work, this type of insurance is going to kick in and provide them financial support. Okay. Now, in income protection insurance, we have workers' compensation, uh, which is also called employers' liability insurance. And in some countries, this is actually compulsory. Okay. Now, disability insurance policies provide uh, support, financial support, in the event the policyholder is unable or has become unable to work because of a disabling illness or injury. Now, this provides monthly support to pay uh, for such obligations such as mortgages. Okay, credit cards and mortgages, credit cards, loans, because of the work you're not being able to work. If you have this kind of insurance, it will kick in and make provide you support. Short-term and long-term disability policies are also available to individuals, but because they tend to be expensive. Long-term policies are usually only obtained by you know by a select audience. You need to be making at least six-figure income. So if you're a doctor or a lawyer, and short-term disability insurance covers an employee typically for a period of up to 6 months. Okay, paying a stipend each month to cover medical bills and other necessities. The long term, like I said, is usually for people with a higher income bracket, usually like doctor, making at least six-figure incomes, like doctors and lawyers here in the U.S. And it covers an individual expenses in the long term, okay, up to such time as they are considered permanently disabled, and therefore insurance often try to encourage person back into employment, uh, or being and because that is preferred to and before declaring them as being unable to work at all, okay, and therefore being totally disabled. So the companies would try and encourage people to get back to work rather than be declared totally disabled. Disability overhead insurance allows business owners to cover any overhead expenses of the business while they are unable to work. If you're self-employed and you get injured on the job or you're sick, so disability overhead insurance allows you to cover the overhead expenses of the business. Okay. Say for example, if you have to hire somebody to take your place. Now, another type of disability insurance is what we call the total permanent disability insurance. Now, this type of insurance kicks in when a person is permanently disabled. For example, if a worker unfortunately uh, loses a limb at work uh, and is unable to do his job, that is the type of insurance that would kick in if that person has this insurance, and uh, it is usually used as as an adjunct to life insurance. But like I said, this would kick in if a person is permanently disabled. Okay. Now, another type of income protection is workers' compensation. Now, this type of insurance, the workers' compensation insurance, what that would do is, uh, if you were if you were injured because of a work-related work-related activity, the injury is work-related. Workers' compensation would replace all or part of the workers' wages lost, and because you were injured on the job, doing an activity that your job required you to do, it will also pay for the accompanying medical expenses. Okay, so that is uh, basically what income protection insurance would be. Now let's move along to casualty insurance. Casualty insurance insures against accidents not necessarily tied to any specific property. Okay. Now, under this falls a broad spectrum of insurance that a number of insurances can be classified as casualty insurance, such as auto, um, workers' compensation, other liability insurances. Okay, uh, crime insurance actually is also a form of casualty insurance that covers the policyholder, the person who is insured, against losses arising from criminal acts of the third party. That doesn't mean that if you're caught stealing, this is going the crime insurance is going to kick in. No, what that means is if uh, there is a crime that is committed by somebody else, and that has impacted you in terms of losses, financial losses, then crime insurance would kick in and try and cover that. Now, companies can obtain crime insurance to cover losses like embezzlement, or if there's pilferage, theft, that type of thing. Uh, in that way, companies are basically protecting themselves against any crime committed, like theft or embezzlement. Okay, then you could have terrorist insurance, which would cover you if there is some terrorist activity. Usually, the premium on this type of insurance tends to be high. Um, Now, after 9/11, in the US, the Terrorism Risk Insurance Act of 2002 uh, basically has set up a federal program, okay, providing a system of shared public and private compensation for insured losses resulting from acts of terrorism. Okay, now this was done in 2002. This was done in 2002, but then it was later extended, okay, until the end of 2014 by Terrorism Risk Insurance Program Reauthorization Act 2007. Okay, another type of casualty insurance would be political risk insurance. Now, basically, what this type of insurance does is that is taken out by businesses uh, that operate in countries that are classified as high risk, uh, maybe because of high crime there, or the political situation there, or there's a revolution that going on, that type of thing. So businesses want to protect themselves while they are doing business in hotspots, so to speak. Uh, the businesses that want to protect themselves, they would take out political risk insurance. Then you have kidnap and risk and ransom insurance. Basically, what that means is if you are working in a country, where the law and order has broken down, there's kidnapping for ransom. So, or your company is operating in a country where you have such law and order situations. What the kidnap and ransom insurance, excuse me, what it's designed to do is to protect individuals and corporations, okay, individuals and companies that operate in these high risk hotspots, high risk areas or hotspots around the world, and when where you have the danger of kidnap, extortion, detention, plane hijacking, that type of thing. Okay, so that basically is your casualty insurance. Now, life insurance. Life insurance basically provides a monetary benefit to a deceased family or other designated beneficiary. Uh, in a nutshell, what that means is person A takes out an insurance policy. When he dies, or he or she dies, his or her family receives a monetary benefit. Now, excuse me, uh, life insurance policies often allow the option of having proceeds paid to the beneficiary as a lump sum or as an annuity. Now, annuity is something that's paid monthly for the rest of life. So either what you could do is if uh, somebody has life insurance and they have named you as the beneficiary, and that person passes away, you as a beneficiary of that person's life insurance, you may have the option of collecting the full insurance as a lump sum payment, or you could also have the insurance company make you regular monthly payments. Okay, so that's the annuity basically is regular monthly payments. Now, certain types of cash of life insurance contracts also accumulate cash value. Okay, now this can be taken by the insured if the policy is surrendered or maybe borrowed against. Okay, now these are annuities or endowment policies are actually financial instruments which to accumulate or liquidate wealth when it's needed. All right. So basically, what you could do is uh, they have a cash value. Okay. So say for example, you have an insurance policy, and after some time you want to borrow against it. Okay. Or you want to surrender it, you don't want it anymore. So then they could have like a cash value that you would receive. Okay. Now, in the US, let's talk about taxes. In the US, the tax on interest income on life insurance policies and annuities are generally deferred. Okay, but uh, in some cases, the benefit derived from tax deferral may be offset by a low return. What that means is uh, you may be getting it tax free or get tax delayed, but because of this benefit, that's paid for by having a lower return. Okay, so that's something you need to think about, and that's why at the beginning of the video and the disclaimer, I mentioned that you need to be talking to a professional who's trained and licensed to give you insurance advice, to sell you insurance, or make for you to to for him to for him or her to be able to make changes to your insurance plans. Okay, so make sure you are talking to a professional. Moving along, burial insurance. Now, this is a very old type of insurance. It's extremely old, and this is basically it's a type of life insurance which is paid out upon the death of the insured, and that money is to be covered is to cover the final expenses like burial, funeral, or any of those expenses. So now this, like I said, this is a very old type of insurance. The Greeks and Romans, they introduced it back in the 600 BC. Okay, So basically, again, this is to assist the family of the deceased to be able to give a respectful final farewell to their loved ones. And this type of insurance, basically is paid out to cover those the costs that for the burial, for the for the funeral, and like I said, it's a very old type of life insurance. Then we have property insurance. Now, property insurance provides protection against risks to property, such as fire, theft, or weather damage. What that basically means is now you could, if you have a house, you could take out a fire insurance, a flood insurance, earthquake insurance. Okay. What that means is if your house catches fire and it's an accident, it's not intentional, the insurance would cover that. If there is, say, for example, flood, so flood insurance would cover if there's damage to your house because of flooding. Uh, Earthquake insurance would cover damages to your house or your building if there's an earthquake. Okay. Now, this type of insurance, like the casualty insurance, may be like may actually be used as a catch-all for a broad category of subtypes of insurance. Okay. For example, the USA flight 1549, uh, the plane had to be landed in the Hudson River, and the plane was written off. So if that US Airways aircraft was if US Airways had property insurance, that property insurance would have kicked in and paid for the cost of the written off aircraft. Okay, so that's just examples of property uh, you know property insurance. Others could be like if there's when we had Hurricane Katrina. Okay, now Hurricane Katrina caused there's a conservative estimate that it caused about $80 billion worth of damage. Okay, there was storm and flood damage. Now, if you have property damage and your house damage, if you have property insurance, and there's when the Hurricane Katrina hit, that insurance would help you pay for the repairs to your house. That would provide you that financial support because of the catastrophe. Um, that's in a nutshell, that's what property insurance is. Something if there's a calamity, there's a fire if a house catches fire, or there's hurricanes, there's flooding, that are there in your house, there's damage to your house or to your building, and you do have property insurance. That property insurance is going to kick in and help you, provide you financial support for repairs. Okay, let's move along to liability. Now, liability insurance is a very broad superset that covers legal claims against the insured. Okay, for example, if you have a homeowner's policy, which would normally include liability coverage, which protects the insured, in the event from a claim, somebody was visiting you and that person slips and falls in your house and breaks a leg. Okay, now they may sue you. So liability insurance, if you have liability insurance, that would kick in and help you out over there. Okay, so like I said, it covers legal claims, right? Now, liability. Let's look at automobile insurance. Now, that also may include an aspect of liability insurance. If you were to, you're driving and your car hits somebody else, and you can you have the crash can cause damage to other people's lives, health, or property. Liability insurance may be able to kick in and protect you. Um, financial the financial world. If you remember, a few years ago, we had the subprime mortgage crisis. Now, though those were also insured, and that was also a source of liability insurance losses. Okay, so that's essentially is liability insurance. Also, in the medical field, uh, doctors may have liability insurance. Say, for example, a doctor not intentionally but unintentionally misdiagnoses a patient, and the patient suffers because of that, and the patient turns around and sues the doctor. The liability insurance would kick in and take care of that lawsuit. Okay, so that's an example of liability insurance. Say for example, the medical malpractice field. Let's move on. Then we have the credit insurance. Now, credit insurance would pay some or all of a loan when the borrower has become insolvent, meaning you cannot meet your commitments. Say for example, you have mortgage, your mortgage insurance, your mortgage is insured. Now, if you were to default through no fault of your own, the mortgage insurance will kick in and pay up your mortgage payments to keep you current. That's a good way of making sure that your credit history is protected in case say for example, you're laid off through no fault of your own. The credit insurance would kick in and keep you current on your mortgage loan. Similarly, you could have credit insurance on your credit cards. And so that too, like if you were, say for example, laid off from work, downsizing. Uh, Now this would not cover if you were terminated with cause. Okay, you need to be laid off through no fault of your own. If you were caught stealing, say for example, if you were not meeting the requirements the job requires you to be performing, your performance was way below average, and the company decides to let you go, that would not be covered by the credit insurance. Credit insurance would cover if you're laid off through no fault of your own. Then it would kick in and keep all your loans current. Okay. The last time. Now, this would be all of the risk, all of the types. Now, here basically what we are doing is it's a catch-all. It's a variety of insurance products which are not already covered by the previous types. So that would, for example, say for example in a car insurance, any damages caused by the own driver, your own car, that might be uh, covered by other types of insurance. Race horses, okay, the bloodstock may be insured, okay. So the owner of that racehorse, the pedigree racehorse, may have the bloodstock insurance policy. Now, what the bloodstock insurance policy does is it covers individual horses or a number of horses under common ownership. So basically what it means is you can have, you know, you could have a horse or a number of horses, and you have joint ownership of that horse or horses with other people. Okay. Now, coverage is typically for mortality as a result of accidents, illness, or disease, but may also extend to infertility because you also want to have maintain your stable of horses. So if the horse is infertile, the insurance may also cover that. If there's in transit loss, veterinary fee, that type of thing. So those type of losses is basically You could have like pet insurance, okay, which may insure your pets against accidents and illnesses. All right. You could have pollution insurance, where coverage is also for liability to third parties arising from contamination of air and water or land. So that type, all those types which do not fall under the previous 10 different types of insurance policies that we have, uh, bunched together in this catch-all of called other types of insurance. So that's it for this video. I hope you liked it, and if you did, please kindly give it a thumbs up, and please kindly also give us your feedback by typing in the comment section. And if you would like to see more videos like this, please subscribe. Thank you.